Hello guys, we try to continue our lessons about how to control risk. Today we try to see something that maybe some people they have never heard of. It is kinds of stocks. Understand that when you trade, don't think that all the stocks are the same. In a way that when you put stop loss, for example, you think that everything is the same. No, it is not. So putting an example, putting a stop loss by percentage, for example, is false if you do it for every stock that you bought. Okay, so I will explain in this video how this kind of stocks will affect you. Okay, let's go to one thing that most of the people know and they like and they dream of, which is penny stocks. Penny stocks, most of the time, are stocks under $5. Some people they say it's $2. Some people say it's $1. But forget about this. I will just give you the exact explanation. It is a stock. Penny stock is a stock that it is small. Some people say it's cheap. I say small. $1, $2, $5, $3, 5 cents, 10 cents. Okay? So these are like penny stocks that are small. Compared to the normal stocks like $20, $30, $100, $200, $500, and $500, excuse me, and $500. These are normal stocks. Okay, normal because when they move to a small percentage. This is the difference. A penny stock, when it moves, it is volatile. You can see 10%, 20% in a day. But in normal stocks, you will not see this always. Sometimes when we have news, like earning date news, when there is a gap up or gap down, you will see that. Okay? But most of the time, the common stocks, the big stocks, bigger, it means bigger than the 5, it means 10, 20, 30, 100, 500, 1000, they move to a certain percentage. If you go to this percentage, you will find, for example, 0.50, or you find 1%, or this is in bigger stocks. If you go to smaller stocks, you will find 5%, 10, 20. It means when they move faster because they are lighter. They are very small, and they can be moved by anyone. If the volume is small, anyone can move these stocks. That's why we have a lot of manipulations. Okay, manipulations, you know, there are a lot of fraud, a lot of manipulation in this kind of stocks. That's why they are so dangerous for beginners. And most of the beginners, when they don't have money, what they do, let's say you have only $2,000 in your account. Can you buy you go to buy Amazon, or you buy Google, which is $1,000? No, you can't. So what you should do is you go to smaller stocks like 5 cents, 10 cents, and you find other people telling you that if you have 1,000, 2,000, in 1 year or two you become millionaire, and you begin following this dream until this 2,000 is gone, and then you have no money, and then you shut your account, you close your account, and then you go to your job. Okay, so try not to dream about these things. Try to be logical, because business is logic. It's logic. Now, when you want to, for example, to put stop loss, penny stocks, it should have wider stop loss. Okay, it's not the same as a common stock because they are volatile. It means when they move, they don't move with a light percentage, but they move with high percentage. I will give you an example. If you buy a stock at $1, and tomorrow you will find it $1.10. Now, when you see these 10 cents, you see it is just 10 cents. It's not a big deal. But according to the stock that you bought, is 10%. It means if the stock today is $1, tomorrow is $1.10. It means your profit just for one day is 10%. So you see, 10% is a lot in one day. Let's say you buy today and you sell it for tomorrow. Just an example. Let's say you buy $10,000 stock that it is $1. Okay, so tomorrow, if the stock is from $1 to $1.10, how much you make? You make $1,000. It's because $1,000 is 10% of $10,000. You see that you make a lot of money just in one day. It's just because the stock is moving fast. Now, let's say the stock goes down 10% tomorrow. It will become 90 cents. What does it mean for you? You are losing 10%. Now, what is this 10%? It is $1,000. And it is a big deal. So, when you are trading penny stocks, the risk is more and more and more. It's not the same as the common stocks. So you should understand the kinds of stocks you are dealing with. Okay? Now, there are some other stocks that they move so fast in few days. For example, there is a hedge fund or there is a mutual fund who is buying extensively. You see sometimes a stock that it is $20, it goes to $40 to $50 in a few days, in 1 week or 2 or 3. There is a big push. Here, this stock was not volatile. It means it was just going $1 a day or $2 a day. But one day there is a big buyer and he pushes the price so good that this stock is moving so good. So understand that here we are talking about how the stock moves. Not the stocks that don't move the same. I have given you an example of penny stocks. Now we are moving to other stocks that can do the same as penny stocks. Okay? But this it's not rare. It happens always in some sectors, like drug sectors. Okay? There is a lot of news, and these companies, they can go so fast. Okay? I will give you just an example. Sometimes with earning date, these companies can go so volatile. One day, I bought a stock at $78 today, for example. The next day, it goes to $135. Now, how it goes to, it means it doubled from 78 to 135. Okay? How it doubled? Because of the news. So understand that sometimes the news will push stocks to something that you will never expect. That's why if you go to search for gap apps of today, for example, the market or gap down, you will see a lot of things that you would never expect to happen. Okay? So understand that stocks that you are dealing with, they are not the same. There are some stocks that they don't move that fast. You find a stock that it is $50, it moves like 10 cents, 20 cents. Although the stock is big, but how it moves is slow and small, although it is a big stock. Now, when you want to put stop loss, don't put too much stop loss because this stock doesn't go that fast. Okay? If you put this stock which is $50 and it goes only 10 cents or 20 cents and you put 5%, for example, you will stay with the stock 1 year or 2 years, and maybe there is nothing. The stock doesn't go up that much, doesn't go to your stop loss, and you get clogged there, or you get stuck there in this trade. We don't want to stay with the trade without making money. If I buy a stock today at $50, and after 2 weeks, 3 weeks, it's only 51 or it's all 49, it means that this stock is not giving anything. So staying a lot is just wasting your time. Okay? If you are following a stock that it is good and you expect a gap up, or you expect something good, and you are just waiting for the breakout or something, this is another thing. Okay? But in general, try to understand that stocks are not the same. Another thing, when you buy a stock that it is $10 and you buy a stock that it is $100, in terms of shares, they are different. Okay? They are different. It means that if you buy a lot of shares of a stock, you can expect a big risk and a big profit. So try to calculate that, and don't just buy 500 or 1,000 or 10,000 shares and without knowing what is your risk. Okay, so it's a big position. Let's say when I talk to you about penny stocks, you buy 5,000, you buy 10,000 shares, 20,000 shares. Okay, let's say the stock is only 10 cents or 20 cents, and you buy a lot. Understand that any move up or down have a very impact on your trade. So understand that. Okay, this is in terms of shares. Okay, so as I told you, there are many things you can see in stocks. So the risk is different from one stock to another according to how it moves. Okay, and what kind of stock is this? Is this a penny stock or not a penny stock? And if it is not penny stock, is it moving fast or is it moving slow? And another thing, the third thing that I've spoken about, is how many shares you bought. This is a part of your risk. If you buy 100 shares, the risk is something, but if you buy 10,000 shares, the risk will be bigger and bigger and bigger. Some when they trade in general, they don't look at the risk in their trade, and this is a very, very big problem in your career as a trader. So all the thing I am saying is just you should take care of these things, and you should at least know how much you are risking in this trade according to the type of stock. Penny stock, which is volatile, it's not the same as a normal stock. And a stock that it is moving so fast in a few days and it will stop. Sometimes these stocks move very fast and then they go down very fast. So you should be able to handle these stocks because they are different. And putting the stop loss will be different from any kind of stock. So this idea of putting just 1%, like 5% or 2% or 1% or 10% or 20%, this is false idea. It will never work in trading and swing trading. So understand from now on that you should be careful of all this. And if you are interested more to go details, you can check training level 8, how to minimize risk and how to maximize profits. It will give you more into details, but with examples and with techniques that you should do. Okay, so thank you very much. Please subscribe to my channel and share it with you guys. And if you have a question, just comment here or send me a private message. Thank you very much.